Obie, thank you very much for just agreeing to do this. I appreciate it. But before we start, I want to give a disclosure that I like to give. Uh, uh, I am not employed, nor am I paid in any way by Grown Rogue. I'm an independent investor whose funds we are now the largest shareholder of Grown Rogue. Uh, UOB are right behind me. Um, Occasionally, I'll get some free samples of Grown Rogue's product, which is excellent. Please do not rely solely on my research and what I say, and please make sure you do your own due diligence. I make mistakes and I'm wrong, and it's important for you to fully understand your own investments and what you're investing in. So, with that out of the way, I want to start before we get into the questions. I want to just remind people why I'm doing this interview. Like, why do I think Grown Rogue is special? Why is it the largest investment in my funds? First off, there is based on my research, my team's research and due diligence, and talking with lots of people and just looking at the results of cannabis companies, there is a shortage of operational excellence in cannabis. Really, really hard to grow high quality cannabis flower at scale. And it's really hard to reproduce those results in more than one state. I've not seen another company do it effectively well. I've seen companies take advantage of what's called limited license states, where there's just less of a supply, because remember, cannabis flower can't cross state lines. And so, but I've never seen companies do it in very, very competitive markets and then reproduce it. Some of you, if you pay attention to some of my interviews, I talk about Glass House. They have a very, very special facility, and they're focused on operational excellence, but they're kind of trapped in California. Um, Grown Rogue is different. Grown Rogue is the number one flower in one of the most competitive markets in the country, which is Oregon, and a top producer in Michigan. And what is so fascinating is Grown Rogue has a very different model, which is being the low cost producer of craft cannabis flower. That have you think of these as these 50,000 square foot hyper efficient kind of like cannabis factories. Uh, that Obie and his team, it's not that the factory or the cultivation facility is special, but instead it's the know-how, it's the process, it's the culture, it's the wild efficiency, where Grown Rogue is one of the lowest cost producers of indoor flower. And not only are their COGS low, their cost of goods sold, but more importantly, their all-in cost, including SG&As, sales general administrative, is really low. They have as few people in the company as possible who do not touch the flower. And they're focused on one thing, which is cultivation excellence. There are no layers of management or consultants like many other cannabis companies. And also, just want to remind everyone who's watching can see this, that consider Obie's office. This is probably the crappiest CEO's office I've ever seen. I love it. It is emblematic of the culture of Grown Rogue. You can literally see in this is in the cultivation facility, and so they spend money on what's important. Grown Rogue is not cheap. They are frugal. They are producing a high quality product, but they keep their costs really low. And what that has led to is phenomenal returns on invested capital once they nail down this model. Grown Road's basic model now going forward is they can invest $10 million in these small, hyper efficient facilities that where they can duplicate, operate cultivation excellence in very competitive markets, and they can produce like around $5 million of EBITDA. So you think you put in 10 million, and then once it gets going, you're producing $5 million of EBITDA a year. They do all the pre-construction planning and don't hire consultants. They don't overbuild. They don't finance them with expensive sale leasebacks. And then they run them with as few people as possible. Michigan was built out with $6 million. And this is really important. We're going to get to part of the reason we're having this call is Grown Rogue has, after a phenomenal run in their stock price, since I first started writing about it at 9 cents, went to as high as like 75. It has pulled back all the way to 35 cents. And the last week, there was a lot of confusion about its results. But I want you to consider Michigan. They spent $6 million and prices have collapsed now almost 80% from the peak. And they still did over $5 million of EBITDA in 2024. Now, it might be a little less, it might be around $4 million now, but just imagine if you could make an investment where I came to you as an investor and I said, you're going to invest $6 million. When times are good, you're going to be producing $6-7 million of EBITDA. When times are bad, $4 million of EBITDA every year, and you're going to have the lowest costs in the space. You would be like, sign me up. And prices fall 80%, and this is still my result. The other key point of Grown Rogue is they benefit from distress. Like no one wants to see other people get hurt, but Grown Rogue was built for price compression. And so I point to you is that they are in Oregon, which is some of the lowest cannabis pricing, in Michigan, and their all-in cost is $600 to $700 a pound. And why that's important is it's not the cost that is baked in with the kitchen sink, $600 or $700. So if it's $800 or more, they're producing free cash flow. And the more pain in the short term, the more opportunity there is to step into, and we'll talk about this, other people's facilities. Grown Rogue has already done this. Acreage abandoned a facility. I think it's this facility you're sitting in, right, Obie? But they abandoned that facility. Grown Rogue stepped in and is producing free cash flow from that facility and operating it at a very exceptional levels. And that what's important is my research says that the all-in cost for most of the MSOs is at least $1,000. Some of them are up for $1,500. Some facilities have already been shut down. We're operating for $2,000 a pound. Below these levels, they lose money, but Grown Rogue still makes it. Finally, the company is now expanding where other people are retrenching. They are turning on New Jersey. New Jersey pricing is 3 to 4x existing markets, though in the long term, pricing is coming down. But remember, Grown Rogue is built for that, and they're going to earn some exceptional money that'll pay back their investment, that'll allow them to invest in new markets. But then they're still going to earn, if you think about that $10 million and then earning $5, maybe $10 million a year, because New Jersey is supply constrained and will be for a while. New Jersey has not hit the income statement yet. It has been delayed. I know Obie and I were hoping that it was going to be Q3 of 2024 at some time. And then in Q4, we were hoping there were just a little bit of delay. Sometimes there's regulatory delays. We're going to start seeing it in Q1 and really see it in Q2. And then the phase 2 expansion, and we'll talk about that in a sec. So Grown Rogue is going to start seeing a lot of growth, and hasn't hit the income statement or cash flow statement. And it's my rough estimate, again, do your own work, that Grown Rogue is poised to double cash flow this year. But this week, this past week, the stock plunged on some confusing numbers out of Q4. There was some chatter online. This is one of the few cannabis stocks that were holding up, and people gleefully jumped on when the stock started falling. And there were a lot of other news that you may have mentioned this past week. So it wasn't the best week to announce some confusing news. And investors, frankly, shot first and asked questions later. So I decided to, sorry for this long-winded intro. I wanted to set the stage. I thought there was no better time to check in with you, Obie, this week. So thank you for coming, Obie. I appreciate it.
Yeah. Good summary, Aaron, and glad to be back. And looking forward to the discussion today.
Yeah. And so to many investors, you announced some confusing numbers last week. I have my own opinion about, kind of what happened. And Were you surprised by last week? And what, in your own opinion, what do you think happened?
I mean, initially, surprise, yes, mostly because of the way we look at our business. I mean, we take a much longer view, I think, than your typical cannabis investor. I mean, we've been in this industry for a long time. I mean, we started the company, 8 years ago. My wife and I, we still haven't sold a single share. And so we tend to look at longer timeframes of growth, knowing that there's a ton of noise that happens inside this industry, from pricing cycles, having lived through, many of these throughout the course of our kind of, time in cannabis. So initially surprised because I thought our year was fantastic. When you compare 24 to 23, really good kind of performance improvement. Revenue was up in both states. EBITDA was up or flat against a pricing kind of environment that was dropping. That being said, after reflecting upon, ultimately where we screwed up, and we screwed up, right? Like the expectations for Grown Rogue being an operationally focused business has expanded, right? And the expectations now are we need to be excellent in all areas of our business. And one of those is communicating properly with our investors. And our Q4 release did not do a good job of that. And I own that, right? Like we've got a team, ultimately all that rolls up to me. And we just did not communicate properly to the market. Really, I think what happened in Q4. So a couple things in Q4 that were driving some of those outcomes, which I think got people a little spooked. And you couple that with some of the trolls that were coming on Twitter, Grown Rogue's kind of sitting up on this level of, kind of resilience within the overall kind of dynamics of our sector. We're kind of pointing to a few specific things that I think got people very skittish, especially in this industry, not to mention some of the, kind of global turmoil that's going on. Q4, especially for our Oregon business, is always going to be a little soft. December and November are not good wholesale months. Even January and February are usually lower wholesale months. So Oregon, I think year over year, Oregon was actually an improvement. It's hard because we also had a year-end change last year. We did a lot of work last year from, building New Jersey, announcing Illinois, investing in a retail dispensary, changing our year-end, just a lot of kind of progress for the company kind of organizationally. And so that year-end change did not allow us to do a very good job of showing year-over-year kind of performance. So it was another thing that was just difficult to present, and we missed it and didn't do it. But generally, again, very happy with the year, surprised by the outcome in terms of what we put in and what the kind of response is from the market. But again, we take a long-term view. And so, the other area we saw some challenge in Q4 is, Michigan is going through a pricing cycle. And you see this in markets that are mature. The difference in an immature market, like we'll experience in New Jersey, is you start with high prices and those prices come down. And the speed at which they come down is anyone's guess. Sometimes it's fast, sometimes it's slow, but it's a pretty consistent downward trend. In mature markets, like you'll see in Oregon, Michigan, you'll see in California, you'll see in Colorado, you get cycles. And Michigan is now going through a pricing cycle where you'll see some stability. You'll see price go up, you'll see price go down. And what we're seeing in Michigan is a little bit of a pricing cycle. And we'll talk more about this, I'm sure, later, and I don't want to belabor the point. A lot of this has to do with, micro dynamics inside of Michigan. There's a lot of distress, a lot of companies going out of business. There's fire sales of product, things like that. But, we're bullish on Michigan, bullish on Oregon, and we couldn't be more excited about what's happening in Jersey. And it was a great learning experience for us. Again, the requirements of our business to deliver great communication, excellence in all these different factors. And, investors get to choose. They get to choose with their wallets. They get to choose on how they view what the business is doing. And I respect some of their positions. I think it was a little overblown, maybe a little bit violent. But, this is cannabis. And so there's going to be days like that and times like that. But, we're super excited about the business. I was in the market last week buying stock because I'm like, I like this price. And so, surprise, yes. Understand it, yes. And one thing I love about Grown Rogue is we will fix it, right? So like we will communicate better. We've heard, we will answer questions better. We'll have better kind of dialogue and output, coming into the market.
Great. I mean, basically what I saw is that, you didn't see New Jersey hit. There's some confusion about sequential growth, just that you have some seasonality, a little bit of seasonality to demand. and then you have a little bit of Michigan pricing. You had no, you typically have no conference call, so there's no venue for investors
Yeah, it's a,
to ask questions, and so that just kind of filled the void in a very
yeah.
scary environment where the MSOS index, I think, is down, some crazy number for the year, and people shot first and ask questions later.
Yeah, I think it's really important too. Growth is not linear, right? Like what we're doing is not trivial. It's not easy. I mean, this is a hard business inside of a hard kind of aggressive growth plan. And there's going to be bumps, right? There's going to be bumps that we don't control, like pricing. There's going to be, I mean, we operate in the most difficult portion of the sector, right? We're cultivators, and we're trying to produce a organic product that is repeatable and consistent time after time. Like that is not, you don't hit perfection on that. And so, we're constantly talking to our team about these periods of excellence that we'll hit. And we'll see these in the markets where we might go 6, 8, 9 months where it's like perfect quality, yield, efficiency, cost, like everything's tight. And what happens through those periods is naturally, it's hard to maintain that red line. It's like, I do a lot of sporting event analogies, like, the 96 Bulls or 98 Bulls, whatever, like they didn't win every game. Like there is times when you go through these little slumps. And what I keep trying to remind my team is it's natural. Let's extend the periods of excellence and shorten the periods of slump. But again, growth is not linear. Like it's distracting. Like there's a lot of time that we focus on Jersey versus Michigan. And part of this is just the learning process that we're going to go through. And super excited, very confident in our ability to deliver it. Seeing good results coming out of Jersey. Very, very bullish on where we're going with respect to the business. And then understanding some of these other parameters that are required for us as we elevate our company across all aspects of it. It's one of the reasons we bought Josh Rosen on, a couple months ago, to like really help with some of these comms and, a little bit more of adults in the room to help with some of the, administrative functions of the business, tightening up practices, better communications, better investor outreach. Because again, it's not a sporting analogy, but I told the team early last week, we're no longer a 14 as honor of March Madness. We're no longer a 14 seed with the hope to get out of the first round, right? The expectations for Grown Rogue now is we're a number 2, number 3 seed. We're supposed to go to the Final Four. And the reality is we should probably win the championship. Like that's the expectation that we've set up for ourselves and that we've embraced and that we're being held accountable to. And we're ready for it. And, we slipped up on the announcement. We won't repeat that. And so, yeah, we're looking forward to continuing to rebuild some of that trust and, show not only our own team, but the investment community, why Grown Rogue is special and things we do are different.
So just some specific questions on that. Will you be able to have a conference call for your first quarter earnings?
Yeah, we'd always planned to start doing conference calls starting this year with Q1, mostly to align around kind of Jersey and some of the excitement around that, but also because of where we've come as a business. And so we will be doing a Q1 conference call sometime in May. We'll put out an announcement on that, probably this week, early next, when we're going to report. Again, we did our year-end change last year to align with a calendar year instead of an October fiscal year. To put us on kind of the same cadence of the majority of the other, kind of companies in our sector. And yeah, it's time to start answering questions. It's time to start being a little bit more, I guess, not even more transparent, because I think we're one of the most transparent businesses in the sector in terms of how we do state segmented, revenue, EBITDA kind of costs. But yeah, a first quarter conference call is coming. And we're excited to kind of, kick that off and give people a chance to ask good questions.
Great. And then I'm assuming hopefully we can see just a little more detail or some cost analysis, because I'm not sure that people fully appreciate just how efficient you are in some of the stuff you've been doing. You can't see when prices come down. This is one of my favorite things of what Glasshouse does. Is they say like, hey, we can't control the price, but you can see where our costs are, and they just make it pretty transparent. Will you be able to share some numbers?
Yeah, we're going to start. We've done a really good job. We were one of the first companies to start doing state segmentation. Verano started doing it, which we were really excited about. Then they stopped doing it. The beauty of state segmentation is it really allows the investor to look at your business in a more holistic manner. Now, the challenge with that is you're always trying to promote good results is you will see, how the sausage gets made. Like you'll see shit, Michigan is having price compression. Like you can't hide anything, which I think is really good. I think gives investors a better way to really evaluate the business, and that transparency, I think, goes a long way toward building credibility and trust. And we did a good job of that throughout 2024. Again, going back to the year end, and it's not an excuse, it's just the reality of things. Like, we no longer had comparable periods. And what we did in the first 3 quarters of 24 was we compared it to the most relevant period. But when we got to Q4, and again, we screwed this up, and I own it. There was no good relevant period, right? We had a 2-month stub period, and it was audited, and it was just really hard. Like even internally, as we've been looking at, like, what is that comparison? It's hard to pull that data together in a way that is kind of accurate and close to an auditable standard. And so going forward, like, you can expect the same level of transparency and detail that you've seen in the past. And I think we're even going to start increasing that, because I think COGS is important. We like to use adjusted EBITDA break even because it looks at the whole business, and you can't kind of play a few of the games around how you kind of delineate costs and things like that. Pricing is another important factor in these markets. I think the goal here is to give investors the best, like almost like the information we use to manage our business. Like, we're like, why not give that to the investor? Like, show them what we care about, talk about it, explain it. These are the things we like. Here's where we're seeing things that we're working on that we're going to get better. Here's where we're seeing things out of our control that are to our benefit or to our detriment. But give them more information to make good decisions. Because again, we know what we're building, and we know our ability to operate in some of these very, very difficult markets and the success we've seen. And so, might as well educate the investors so they can start to come along on that journey with us a little bit more intimate way.
Great. I have to ask one of the craziest things I heard. He asked you privately, but just to tell you how people were freaking out and some of these anonymous trolls. The craziest thing I heard is someone pulled up a couple year ago filing and was like, Roanoke's going to be delisted. I kind of have to ask this. I know it's kind of laughable, but are you going to be delisted, or is there any risk of that?
I was going to try to avoid talking to some of the, the trolls that we see. I mean, the Twitter space has gotten so toxic, and so
I know. I myself was commenting to people that I was trying to avoid it, and I actually encouraged, just so people don't know, I was like, please, Obie, just don't respond. But on this segment, could you just address that?
Yeah, no, of course. It's very easy to take information and kind of parse it the way you want. And so, I also appreciate the fact that, and again, I'm not trying to like say we sit on a pedestal, but like we were outperforming the market in a way I think that was unique. And so, it's a really easy kind of target to kind of want to pull it down a little bit. And I respect that. I mean, I don't agree with it, but I can respect it. But the short answer is no, we're not getting delisted. And so this is a long, complicated process that we spent, painful time years ago. And so this dates back to a pre-public auditing standard issue. And so I won't get into all the gory details. I'm happy to anyone that wants to talk and get like the lesson of how this works. But the short story is we filed our going public under a certain standard. That standard was not applicable to the SEC. Right. So what that means is we did not have comparable period audit. So what we had to do, and we talked with the SEC originally, this is years ago, being like, hey, like we just screwed up. We forgot to file this stupid little form. We didn't know. It would be like a 1-page form, which would have resolved this whole issue. We didn't file that form. They're like, nope, sorry. The only way to fix this is to go through and re-audit those periods to the right standard. And this is the difference between like, it's like testing. I already know it's not like our numbers were wrong. It's just a testing standard that has different kind of criteria. And we're like, oh, well, that sounds off. We have to re-audit 2 years of financial statements. So in order to get that done, it took us like 1.5 years. We had to engage with 4 auditors. We had to engage with auditors that were part of our shell before we were even involved. That's how far we had to go back in, like to like 2015 auditors. Got it done. Got it filed. And then the SEC said, well, just kidding. We actually think because you didn't do this, the best solution here would be to, delist you guys because that's going to protect your shareholders. So then we went through a big argument like, how is that going to help our shareholders? And they're like, well, it just will. We're like, okay, this is stupid. And they're like, well, the way you fix this is you re-register. And we're like, okay, we're just going to re-register. And so now we've gone through the process. We've completed the re-registration process. I think it's Jake Wooten on our change in work. It's either an S1 or an F1. I forget exactly which technical. I think it's an F1. I can't remember if it's an F1 or an S1, but you file that with the SEC. They go through the process. It's almost like filing like a prospectus, or like when we went public, it's essentially a registration statement. And you go through that process, you essentially create a re-registration, and then this SEC thing goes away. And so this guy pulled a 2023 kind of document that was, did not even talk about the most recent kind of components, again, with the intention to try and create uncertainty and fear in an already skittish environment. Now, why he would want to drive or drag Grown Rogue down, I don't know. You'd have to ask him. But it's it's interesting, right? Because the people should be actually looking at Grown Rogue going like, how can we draw other companies up? But
well, you're not describing Twitter. I can just hold you. You've already probably spent way too much time on this. So let's just you don't understand Twitter is your question.
I don't understand Twitter. That's true.
Okay.
Very true.
So let me go.
Delisted.
Yeah. Okay, good. There was, I think the other thing that surprised people, and that people were just questioning, was there wasn't really that much mention of a New Jersey. People inferred, A, you're not talking about it, so maybe things aren't going. And some people online are like, oh, things must not be going well. And I'm wondering if you could just give an update on how you think it's going, the demand, and the reception of Grown Rogue launching.
It's going fantastic. Now, we had put out a standalone press release in February specific to Jersey, what we were doing with our cultivation asset as well as our retail partnership there. We just missed it in the Q4. We should have talked about Jersey, and we're actually working on something that will rectify that we'll put out in the next, probably maybe not this week, but next week. That's going to give a lot more flavor around Jersey specifically, because we understand that's very important. But the short of it is, like, we built the facility, we turned it on in August, we had our first crop in November, we started selling, mid-December, right before the holiday. So kind of like the soft launch in December, and then really hit the ground running in Q1. Our internal kind of objective always was it would take 6 to 12 months, because you don't just go to a brand new facility, brand new state, brand new team, and expect to be at Oregon, Michigan level efficiencies and sell through in day one. I mean, that would be amazing, right? But that's just an unrealistic expectation. Like, you got to train a team, you got to build consumer kind of brand loyalty and things like that. But in, less than a little over 3 months, we're in over half the shops. We've had tremendous reordering and sell-through of our product. Phase 1 is 500 to 600 pounds. We think we'll be at full sell-through of phase 1 by the end of Q2. I mean, this is, again, functionally why Grown Rogue, I think, is a little bit different. Like, our total capacity in Jersey will be 1,000 to 1,200 pounds a month. We built it in phases because we know you can't walk into a new market and just sell 1,000 pounds the first month. Like, even walking into a market and selling 500 pounds the first month, like, you have to build relationships. You have to have the product. You have to convince people that it's good. I mean, it's expensive there. Like, pricing in Jersey is expensive, which is to our benefit, but it's also for the consumer. Maybe it's a little bit challenging for them to pick a new brand without really learning that the quality is going to be there. We're seeing fantastic pricing. I mean, like, our best premium product is selling for well over $3,000 a pound. I mean, we're seeing lower quality product as we work through kinks and get our cultivation where we want it, $2,000 a pound. So you're getting quite a pricing diversity inside the market. I think the other thing around Jersey is it's not undersaturated, or it's not undersupplied, right? This is actually not an undersupplied market.
At these prices.
Agreed, at these prices. And we heard, and this is, again, just being transparent, one of the mistakes, we thought undersupplied meant, high pricing meant undersupplied. And at these prices, there's plenty of supply, right? And so we're having to earn that a little bit. So that's going to take not a lot longer, but it takes a little bit longer. It's not like walking into a medical to adult use flip where the demand goes 3x. The demand's set. Now, as prices start to come down, which we expect, we've seen a little bit of price pressure already in Jersey. And by little bit, I mean a $3,800 to a $3,500 pound in terms of our premium product. Like, it's minuscule. But you will see demand pick up as pricing kind of, starts to normalize closer to what, anyway, you just see more demand as pricing comes down, that's for sure. But we're well on our way. We're in over half the shops. Reorder rates are great. Sell-through is picking up like we want. Like, we're seeing, month over month progression. The first step really for us, and this is how you build into these markets, is, the step one is build the relationship with the buyer, because our customers ultimately are the retail buyers. And to be in over 50% of the shops in the first 3 months, very pleased with that progress, right? Second step is, okay, now you have to make sure you get sell through and you get pull through that inventory through the shop. So the next step is to educate the customer. And so we've been investing and spending a lot of time and energy with brand activation, people in the shops, talking to the customers, educating them, convincing them there's good deal, running some promotions. And we're starting to see the fruits of that labor. But again, my expectation for Jersey is Q1 will be good. Q2, we're going to be at where we expect, which is phase one sell-through is where we want it. That's selling 500 to 600 pounds a month in that market. We are going to begin construction on phase two, starting, like we're already doing some electrical and things like that. And phase two construction will double our capacity, taking us from 5 to 6 to 1,000 to 1,200 pounds a month. We will turn those rooms on very strategically, not turning all 4 rooms to double capacity in month one. We'll turn on like a room at a time. So we'll balance additional inventory pull and, kind of sales with the right working capital and kind of cultivation practices, with the goal being that we'll be at full sell-through of the entire facility, phase two, by the early part of 26. And again, our goal that we stated, a year and a half ago, 2 years ago, when we started this project, was we thought we'd be at full capacity by the end of 25. And so we're a quarter behind, which I think when you plan out multi-year projects to be within a quarter of your expectation, I'm pretty pleased with, the way our team's executing and delivering. Again, this is hard. It's not supposed to be easy. And I think we're executing very, very well against the plan. And, as we report Q1, Q2, like, the market will start realizing that. The other thing I think in Jersey that people didn't quite appreciate is the structure of our investment. And I think this is a really important fact. And we file all this stuff, we educate people. But one of the things I've realized is, you got to really hold the hand of these investors to make sure they remember. I mean, we live in the business, like I live in the business, right? Like it's part of my life. Like it's in my soul. Not everyone cares as much about Grown Rogue as I do, rightly so. And so making sure they really understand the structure. And so the majority of our investment in New Jersey is in the form of a loan, right? We made a $2 million equity contribution. So as investors look at the return on capital and what we do, we have $2 million of equity that will get us to the 70%. The remainder of our contribution is in the form of a senior secured debt facility. And with that facility, which is at good interest rates, we get all of that money back first. So before any distributions go to the partners, any cash is put out to the other members and our partners in that business, Grown Rogue will recoup 100% of our debt. And I think we've invested $7.5 million of debt into the business. So add interest to that, Grown Rogue should be receiving, I don't know the exact number, 7 million, a little over 7 of actual debt investment. And so plus interest, we'll be getting $8 million back first, somewhere in that range. But all that money comes back before you start seeing any distribution outwards. And we think that's a very advantageous kind of outcome for our shareholders. We think it's the best way to manage our business. That being said, the regulatory structure in Jersey, and this is another kind of critical component is, we can't take our 70% ownership until 2 years after we started operations. So it's like August of 26. In the meantime, we have 44%. So we will be reporting Jersey in the financials. We will be communicating properly the way this works, but we can't consolidate Jersey yet. And so the market will understand what Jersey is doing, but the face of the financials will not be a consolidated factor for New Jersey. We think that's an important point for people to understand. Doesn't change the mechanics of how we're managing Jersey, the work that we're doing there, the returns we're seeing. But again, making sure people are fully aware of the practices Grown Rogue's deploying and how that gets represented in how we manage the business, but also how we report out our results externally.
And that's why you might see just some of it flowing through other income or interest income is because
Yep.
there's a big portion that's related to the loan. Is that right?
Correct. Yeah. I mean, that was some of what came into the interest income around corporate this year or in Q4. And that's, again, I think that's why we need to segment. And I think this is be really helpful to investors is the way I look at our business is, Grown Rogue Unlimited, our parent company, is really, it's like an asset holder, right? It holds the corporate team that provides the financial accounting and back end, plus our technical kind of support. And it's lean, right? It's a small team. There's 15 people at corporate or something like that. And that includes our technical support, like our national director of sales, cultivation, post-harvest, kind of the way we run our businesses in the States. And then our states are like profit centers. And so the way I think investors should look at our business is how are your profit centers performing, right? These are the states where you're actually, your business is growing and selling weed. That's the business. And you're going to have, we got Oregon, Michigan, Jersey, Illinois soon, and we plan to keep on adding these profit centers. And then you have Grown Rogue Corporate, which again is going to be looking at, okay, how do we fund these various objectives? Like what are investments we may want to make either in the States for our core business of growing and selling weed, or like our investment in Nile came through corporate. Like what does that look like from a retail investment? And that corporate business, while it's not in our core business of growing and selling weed, it's making good strategic investments like this loan we made into Abco. And there should be some recognition, and we will separate this and talk about it, that yes, there's interest income now that's being obtained that will eventually go away, but it's going to be transferred into the core portion of our business, which is the distributions and the profits that are created from, the operating center inside of New Jersey. But to disregard corporate is like it's like our services work that we did with Vireo that we terminated. I mean, it's the same thing. That was really a corporate objective. It's not like Oregon or Michigan were helping that. Like we took corporate team, corporate resources and put it into, that project. And, while that was kind of a one-off, it's no longer active. I mean, we like that project. I think getting out of it and allowing us to focus on our other markets is to our benefit long-term and to our shareholders. But, I hate using the word corporate team. That corporate team is always looking for creative ways to maximize value, whether it's through services, good investments, and we'll continue to do that. And we'll talk about it. We'll disclose it properly and make sure there's no confusion.
That's great. And so important for me is and appreciate you just that explanation. When I think about New Jersey, the ramp and then cash flow, it sounds like the real repayment of the loan and cash flow will really start happening back to corporate in the second half of the year, right? Because you're just kind of ramping up and get going. You'll kind of hit where you want to get Q2. We're going to start seeing that sales and income, like the sales and income on the income statement. But in terms of cash flow flowing to the actual balance sheet, it's probably a Q3, Q4. Is that a accurate way?
I think we'll start seeing, I would say Q1 a little. I mean, mostly we're building the cash and then letting it sit in Abco, right? We want to make sure there's working capital there, but we're making money in New Jersey already. Is it a lot of money? No, not yet. we just turned it on. We're 3 months into this project. Q2, I think we'll start generating cash and start pulling some of that back to the balance sheet. By Q3, gotcha. Q4, my expectations, the loans will be repaid.
Oh wow, okay.
I mean, even at 500 or 600 pounds, or even a $2,500 price cost of or pricing. I mean, it's real cash. And again, we're efficient. That's one of the things I really, again, it goes back to my long-term view of our business. The things that we focus on and being public, we try still to make the right decisions for the long term, right? And so where we're focused on is what's the yields look like? How is our cost control? Like, what's the sell-through? Doing it the right way, not just like blowing things into the market without some sort of repeatable or relationship that's being built. Like we're going to operate in Jersey for the next 10 years, right? We want to make sure we set up the right foundation, because if there's anything I learned at Grown Rogue early is if you don't foundationally develop your business, and each of these states is a new business properly, it is really hard to fix it. Think about all the distress that's going on. Think about all the companies that are having to go back and be like, God, we scaled way too fast. We set up the right or the wrong habits. And I talk about habits a lot. It's so hard to fix habits. That's why we want to do it. You do it right from the beginning. I spent 2 years of hell in Oregon, like from like 19 to 20 after we went public, after I disregarded some of these core fundamental and foundational things that build the right business. And God, it was painful to go fix it. And so in Jersey, we know we want to do it right. Set it up right, deliver it, because we're going to be there for, again, like, look, we're going to operate Jersey for the next 10 plus years. Like that'll be a core market for us for a long time. And you only get one chance to do it right the first time. And trust me, like rebuilding it is way worse than doing it the right way.
If you're a cannabis investor, you're watching the other companies, and it is
Yeah,
almost impossible. But
yep.
let's go. So that's a wonderful. Thank you for that. Let's talk Michigan for a second. It's going through a pricing cycle.
Yep.
I think what's helpful is we saw a fall. We've been seeing a fall, kind of consistent fall. And what's also interesting is Ohio turned on, probably took some demand from it as well. Our prices, you've described how it's come down in Q4, came down last year. How are prices since Q4?
They're close. I think we've seen a tad bit more. Like it's really hard, right? Because like pricing on like a month to month or a week to week. I mean, we're a wholesaler, right? Like we'll sell stuff at 1,000, we'll sell stuff at 700. Like there's quite a bit of variability, but I would say generally for the quality that we are known for putting on market, pricing is pretty stabilized. But it did go through compression. We're probably down 20-25% in pricing in the last 12 months. I mean, Michigan's just going through one of its cycles. I mean, and with that, you're seeing. Again, it sucks, right? Just pricing going down sucks. Like whether it's in stock, your price, your weed, like pricing going up is great. That's what we all want to see, up and to the right. But the reality is that's not how these markets function. And Michigan's been a really strong market for us for years. And don't forget, I mean, we invested what I think you said it earlier, $6 million, and we did $5 million EBITDA this year. Like it's a great investment. So you see a pricing cycle, and instead of doing 5 or 6, you do 3 or 4. Like it sucks. I want to have 7 or 8 from 5 to 6, but like this is just part of working inside these industries. Like we're not immune to things that happen that are outside of our control. Now in Michigan last year, we actually had a really strong year to start, and that was factored on 2 things. One was there was no price compression that occurred in the first part of the year. We didn't see that starting until like kind of June, July, towards the back half. We saw it early in Oregon, right? Like we saw a macro pricing environment. I think we saw the same thing in California. Like overall pricing in the US was down.
You saw it in California. I mean, Glass House reported it. It's like Q4
exactly.
It just collapsed.
Yeah, and so we saw it earlier in Oregon, and what we did is we overcome pressure with force. And so what we did in Oregon is we saw it in like February, and we got our team together and we said, we're going to drive yield quality. We're going to control things we do. We're tightening costs. And we ended up with a pretty flat year, even up on revenue a little bit, margins compressed, just through the things we control. Now, Michigan had strong pricing through the first part of the year, coupled with the things that grown. I mean, this is why I think we're uniquely positioned to be very successful is with essentially no CapEx. We made a schedule change inside of our business in Michigan that we had historically managed the way we ran our crop scheduling differently. And it made sense for the scale of the facility at that point. And as we fully finished what we're calling kind of phase 1 of Michigan, which is our 50,000 square feet, there's like another 25 we could build into. We realized if we changed our schedule and went from veg in place to a dedicated veg room, we could increase the number of crops per room and the turns we got, which improves yield. And so Michigan in 2024, I think we had a 20% improvement in yield. We went from, 1,000 pounds the year before to 12,000 pounds. Like it was a demonstrable change in production yield. And you couple that with good pricing, we saw kind of, I wouldn't call it an outlier because I think we'll get back to that at some point, but it was kind of a really strong year for Michigan. And so as you see pricing compress, and you see the fact that we don't have some magic thing to increase our yields a bunch in 25, like we'll see some pressure in Michigan this year. It's going to be down. There's just no way to hide it. Like that's the way it's going to be. Is that the future of our business? No. Are we capable of working through that and understanding what it's going to be like? Yes. And, we're going to do the things we can control. We're going to drive yield. Like we've done some technology improvements around some of our lighting technologies, which, I don't think we'll get 20% improvement, but I bet we're going to see an improvement in yield again this year. We'll drive potency and quality of the genetics, all these things that we control, to offset some of these, kind of natural cycles. And then, the cure to low price is low price, right? You hear this played out all the time. And so what you're already seeing in Michigan, and it's sad, but this is why again, we're not immune to the realities of this industry, but where we specialize is in, you said it earlier, the low cost production, right? Who's going out of business in Michigan or shutting down capacity? What was Green Peak went out of business last year? Livewell, which was the #1 flower producer in the state that was owned by PharmaCann, just shut down. They're out. We've heard rumors of 2 or 3 other larger companies that are either shutting their doors or closing off capacity. Again, because their cost of production, as you said, these bigger companies is too high. Like Grown Rogue's cost of production is still good. And so as you get into these movements, this fluidity inside these markets, what happens to Grown Rogue is, our profits will shrink a little bit, but we're still profitable. Like we will not get down below our kind of inherent cost of production. That's one of the things that's the beauty of being a low cost producer. And we continue to tighten our practices, like profits and all that stuff is cyclical. COGS improvements, efficiency improvements, that thing lasts forever. And so we'll take these opportunities to tighten up, learn, get a little bit more efficient. And when prices recover, we'll be well positioned to take advantage of it. And, again, instead of posting a $3 or $4 million a year EBITDA, we'll be back to the, 5 to 6s where we think Michigan should sit. And so you'll see some variability in there, but again, not worried about Michigan. It's the nature of, and you're seeing it across the space, right?
You're seeing it across the space in other states as well. So that's really, and then the other thing I think about is just low prices are great. So it's like the other thing, what I think about is if we get into uncertain economic times or a recession and people start pulling back kind of on the wallets. And this is, I think about Glass House and just some of the other companies I'm invested in, but especially Grown Rogue is like, this is where you were kind of made for this. Like you did your whole goal, right, is to provide the best possible flower for the lowest price.
Yep. I mean, we like high prices. Don't get me wrong. We love making money. But I mean, we went through this cycle. I mean, this is when I got Oregon to become the foundation of what our future would look like. We went through this in Oregon, like, 2019, 2020, when I was so far down inside of our business during those years, like fixing things, like 21, like when we saw the hemp issue that pushed pricing all the way down from I think coming out of COVID, we were like $1,200 pounds. And then during 21, we went to like $6. I mean, the level of intensity that we
$600,
$700, like crazy pricing.
I'm pretty sure every MSO would be completely shut down at 600 or 700.
But we were forced to build the business that we are now expanding upon. And again, why no one likes it, and I don't like it either. These are natural cycles inside the cannabis space. And, I think Grown Rogue, I mean, it's not a problem. I mean, Michigan was doing what, like mid-40s EBITDA? I mean, that's like a good gross margin for a lot of companies. And so now it might be in the 30s and everyone's like, oh my God, Michigan's falling off a cliff. It's like, come on, let's put these things in perspective a little bit. Like we are not immune, and I'll take a 30% EBITDA margin in some of these markets all day long. Like it's great. Like we're very happy with that. Considering our investment kind of criteria, the amount of money it takes us to build these things. I mean, again, like we've invested $6 million into Michigan. Like the return on our invested capital in that market is fantastic. And the other things we'll start doing during these periods of distress, right, is, do we add some capacity? Do we look at doing what we did in Oregon, right? One of the things in Oregon during the period of distress is we bought the facility I'm sitting in. I mean, we paid what, $2 million for this thing, and it produces 7,000-8,000 pounds a year. I mean, the return on that capital is fantastic. And we'll see the same thing in Michigan. You know, the question comes down to, is that the right use of our energy, our capital, our time? But there will be a lot of opportunity in Michigan if we want to start to grab a little bit more share. Do we push more pre-rolls? Do we build like an infused line? Do we add more capacity and increase our, you know, volumes on a monthly basis? You know, we like the 1,000 pound a month kind of model. But I also think that's going to be a little bit market specific, like 1,000 pounds in Oregon may make a lot of sense. And that's just our indoor, right? Our outdoor adds another like 1,000 pounds a month. But Michigan, with the market's $3 billion a year, can we go, you know, it's not 1,000 in Michigan, it should be 1,500. Let's add a little bit more capacity. And you start coming over a little bit of this, you know, pricing pressure, and again, meeting pressure with force is what we like to call it.
No, that's great. So when I think about for phase two, and I think about the various cash flows, I think about the CapEx you got to spend to turn on phase two, and I think about turning on Illinois, which is another what, $8 or $10 million. What are your thoughts on like funding that expansion versus cash flow, and how are you thinking about that? I think the other thing that investors worry about is any kind of dilution or share issuance or some of these crazy interest rates that some people have to pay, and they're watching, you know, other companies really struggle. No, they're all kind of retrenching and retreating, but you're kind of stepping forward and spending money on growth when others are not. How should investors think about
I mean, our goal is to be aggressive, but disciplined. And so, you know, we just raised a $7 million facility, you know, that is at really, really good interest rates. So we'll be able to use some of that cash we won't do both Jersey phase two and Illinois, right? We need probably, you know, 10 for Illinois, another 4 for New Jersey to do phase two. So some portion of that will be used to kind of finish the phase two in New Jersey. And then, you know, Illinois is under like a slow construction process. We've started that already. You know, we have 2 different businesses that'll be operating there. One is our cultivation and one is the processing division. The processing division, we hope, will be turned on sometime this summer. Cultivation, we're still optimistic. You know, it's a 2026 kind of sales scenario for us, you know, which is kind of meeting our, you know, 1 new market per year. You know, we're like, so Jersey's really the 2025 story. Illinois will be 2026. You know, we'll keep looking for the next one. There's other opportunities for us to get reasonably priced debt that would help kind of facilitate this. We're not really interested in taking any more dilutive capital, especially with the, you know.
would any part of that debt have like warrants or dilution when you say
No,
it would just be straight debt?
Yeah, just straight term debt. I mean, interest rates are high for our sector. But again, I think the only thing that makes me nervous a little bit about debt is just, you know, it's the timeline at which your repayments have to occur, and can you spin things up quickly enough? But like when you look at like even like a, you know, like probably rates are in the 13% range, right? Like that's probably like low to mid teens. Like our return on capital is significantly better than that, but it's the timeline at which that needs to occur. And so that's what always gives me a little bit like with debt, you're forced to really deliver on a very structured timeline. And as we know, timelines are difficult to predict in these markets. You know, there's construction delays, there's regulatory delays. I mean, there's, you know, sales process and like, you know, what that takes in terms of building your customer base. But I think, you know, Grown-Up's got a great balance sheet. We're not leveraged at all. I think a little bit of debt makes sense. And again, like, you know, $10 million to go build. I mean, even a mature pricing, you know, $5 million a year EBIT. I mean, that's a fantastic return on capital. And we think in the markets that we're targeting, you know, we should see a 10 plus, like $10 million get you 10 million of EBITDA, maybe even more. And I mean, that's like a no brainer all day long that you take that bet. And again,
Yeah, especially when others cannot.
And Jersey is, I mean, functionally, Jersey's proving out what we said. I mean, everyone was like, well, can you scale? And the first thing was, okay, can you get another project? We did that. Okay, can you finance it? We did that. Oh, well, can you build it? We did that. Oh, well, can you harvest crops? We did that. Well, can you sell the weed? We're doing that. Right. Like, and so.
But the investors haven't seen that yet. Hopefully we'll start seeing that Q1.
Sure. Yeah, no, that's fair.
I think if investors saw New Jersey numbers, they would have your stock would be trading at a different price right now.
Yeah, totally. And we're, again, like I said, we're going to put out better, just an update around that. That's more specific, and Q1 will have a much more detail. And so, yeah, it's, again, you're the largest shareholder now, and I appreciate that. I'm still coming for that position, but like, I still haven't sold a single share the whole time, and we've been in the business for 8 years. We bought more shares last week. Like, our view on this business long term in this industry has never been more strong, and bullish on what Grown Rogues set out to accomplish. And again, we're not looking at it month to month, day to day, quarter to quarter. Like, we're taking where do we want to be in the next 2 to 5 years, and what does that business look like? Knowing that, again, path to success is not a straight line. There's bumps and hurdles and dips and accelerations, and things go your way, things you don't. And again, and for the most part, I think our core shareholders, and I know our core team, is fully aligned with that strategy.
Yeah. Yeah, no, I was buying, you could look at my filings online. I was buying right alongside you, I saw your filing on Friday but I was buying right outside. Last question I want to ask is, and this has been fantastic. Thank you so much for your time. Is thinking about Grown Rogue taking advantage of distress in cannabis. And I want to give you just one example that was just announced. We've mentioned some of this already, but when I think about like Innovative Properties, one of the big real estate finance cannabis companies announcing multiple defaults, from PharmaCann to Forefront, and you think about the amount of distress, you think about this wall of debt that's coming for a lot of highly levered companies that weren't set up foundationally correct. And I think about something that possibly makes me even more bullish about Grown Rogue is the opportunity from a capital perspective to do what you did with your acreage, the facility you're sitting in now, where you can step in, it's fully built out. There is no large capex up front, or you could negotiate with an empty facility to be like, hey, we can take this over and at least pay you some amount of rent. What are your thoughts on that? Are you having any conversations? Do you think there's going to be opportunity as this kind of distress and all these restructurings start happening for Grown Rogue? And are you positioned to be able to take advantage of that?
I mean, we've always said our key to success is, build it yourself, kind of new activation, new greenfield, take something over, or do like the services thing we do with Vireo. And we're prepared for all three of those. I think as it relates to the services, that's less exciting to us because we like to actually own what we do, because we feel more accountable and like we're responsible for outcomes in a little bit different way. Whether we build it or take it over, we're kind of indifferent. It depends upon what we think is the best use of capital. Obviously, taking something over that's distressed is a lower cost of capital. There might be a slightly longer ramp because it's probably in a market that's a little bit more mature. And you got to be really careful about the design criteria of that, and then what ultimately the rates look like. And so we looked at one of these in Michigan, I don't know, 18 months ago. That was more of like they wanted to lease it back to us. I was like, at first I was like, oh, this doesn't make any sense. Then I ran some numbers and I was like, oh, this is really good for the first like 3-4 years. And then it gets really punitive in terms, almost like a disguised sale leaseback, which we've done a good job of avoiding, which have these kind of escalators. So as price comes down, your costs are going up. And so you got to be really careful. That being said, there's a lot of facilities that are going offline. And there's going to be a tremendous amount of opportunity and potential for us to look at some of those and decide, is that the next market we go into? Is there something in Pennsylvania or Ohio or New York where accelerate? I mean, essentially that's what you're doing. You are ideally lowering your upfront capital cost, but you're also accelerating your time to market. So instead of spending, 9 to 12 months to build something, you might be up and operational in 6 months. Like, bring the plants in, build the team, get your first harvest in, you're in market much quicker. And so there's going to be plenty of those opportunities, whether or not they make sense and can get done. That's where the rubber meets the road and the details become really important. But my suspicion is Grown Rogue will activate one of those in the next 18 to 24. It could be 6 months, but within the next 24 months, we'll probably have activated on one of these opportunities, because they're coming, and it's going to be like a wall. You're seeing like Gold Flora, Forefront, PharmaCann, all of a sudden you're just like, oh crap, this is happening. And within that, you're going to see some really, really interesting opportunities. You know, a lot of it comes down to the lenders and kind of the, you know, a lot of these are owned by the sale leasebacks. You know, they all talk the right game. They want the right operator because they want a long-term tenant. But there's a lot of companies that are willing to come in and pay premiums that they can't actually afford. And so, you know, they'll say they want the right operator. And then when we're like, hey, we'll pay you $1 and someone else says, we'll pay you $5, they're going to take the $5 and put that for.
And then like 2 years later, they go under.
That's exactly right. And so, you know, we've been having some discussions around some creative ways to kind of balance those different facets. But yeah, it's that highly likely that we take advantage of another one like we did here at Acreage, which has turned out fantastically for us.
Great. Well, it's thank you very much for this. I mean, I think you're about as well positioned as a company can be for the current environment, and kind of proud to be an investor and excited for your Q1 to see the progress in New Jersey, to have your first conference call, which will also be exciting as a company. And I just appreciate your time today. Appreciate all the hard work as an investor.
Yep. Yeah. Thanks for having me on, Aaron. Always good to catch up with you and kind of give an update of the status of things. And yeah, appreciate everything you do for us.
Thanks.